Hello. Thank you, Aditya. Thank you so much. Uh, as we reflect back, the past year has been a roller coaster of opportunities, challenges, be it for investors, be it for startup founders. The year 2023 was a year of cautious optimism. We know that a lot of good things are waiting for us in the next year, but this year was about correction. We have a very illustrious panel today with us, and I have the responsibility to get most of your answers there. Now, without wasting time, we have a variety of people with us, and these are the very, very senior people of the ecosystem. When we talk about Nandini, Miss Nandini Mansinghka is the founder of Indian Angels Network. She knows how Angels Network work, and now when it has got acquired by 361, she knows how venture capital works. Before we come to, we discuss the topic in detail. I will also come to Dr. Malik. When I first met Dr. Malik, I got to know that he is just 1 kilometer away from my home. So in some sense, he is my neighbor. Everybody knows Dr. Malik. He has built a good, successful company, Innovate, and then sold it to Orios. And both of the Ritesh, Dr. Ritesh Malik and Ritesh Agrawal, are good friends. I'm now coming to Mr. Rehan Khan. He's the managing partner of Orios, but he started his investment journey as an angel investor only with Dhruv, if I'm not wrong. We have Siba, Panda. He is the managing partner for Orios. And also now we know that we have Siba on the panel, but he has a partner who is Rahul, and he is ex-Axis Bank. And I knew him already when I was preparing for the panel, and I got to know and studied about this. And then I figured out that we are having another partner on the panel. So it's a great pleasure to be sitting all of you. And I'm a little under pressure. I'm not sure, but let's open the floor. With my first question, I would request all of you to kind of explain or summarize how was year 2023 from an investor's lens. We saw a lot of loopholes, we saw a lot of breakdowns happen, but we also saw many of the successful exits, many of the IPOs happen in the year 2023. Can we have your thoughts? How was 2023 for Nandini, if you look at it?
So I think 2023 is the year when I would say the Indian startup ecosystem has actually come into its teenage. You know, I've been in this ecosystem for now about 15 years. There's a sea change on what I saw when we started out to now. And today, I think it's a good place to be in, because while you hear a lot of, sounds about correction and, things going down, valuations not happening, it is actually a time for us to sit back and pause and say, are we actually moving too fast? Are we building the blocks that are required for us to, it's not just enough for us to chase a ranking in the world global order and in the startup ecosystem. Is the robustness there? And I think this is the year when those questions have started coming up. And those questions are there for everybody, for the founders, for VC funds and platforms like ours, and individual investors who are wanting to get into this space.
Good to know. Good to know. Dr. Malik, if you quickly share your take on how was year 2023, how was some of the discussions with entrepreneurs or let's say your co-investors?
I think 2023 was the best year. In my opinion, महाभारत में बहुत अच्छी चीज लिखी हुई है, तीर को जितना आगे भेजना है, धनुष को उतना पीछे खींचे. 2023 was a very important year for reflection. Beautiful. For founders, for investors, for understanding what exactly are we here to build. Are we here to only build a unicorn? Are we here to truly create value for everyone in the ecosystem? In my opinion, out of 113 unicorns that we have, today 78 of them are bleeding money. And they are not just bleeding money, a lot of them are actually scaling wrong product market fits. In my opinion, 2023 will enable a lot of good founders to reflect upon their journey immediately catapult their journey and ensure that profitability remains at the center stone of all their value creation. Apart from that, we are in the business of co-working. We have over 40 campuses pan-India. I get this question asked by a lot of founders, what is the best time to start a business? And the answer is, the best time to start a business was yesterday, the next best time is now. VC, capital, all these are byproducts. Create a good product market fit, ensure that your customers become your biggest cheerleaders, and don't run after valuations, don't run after. I've seen, at least in the past 2 years, in my opinion, almost 50% of companies that I have invested in are going to go bust, because I know that those were rounds of $30 million seed rounds. They won't make sense. So in my opinion, being very cognizant of valuations is now extremely important.
I somewhat agree. Now, Mr. Khan, we talk about early stage investments. The year 2023, please,
At some point here.
please.
Hi. Yeah. So I
Closer to
think,
you.
like everyone runs in their life, from school days to college days to doing something in profession. Similar in the startup space or the venture space, it's a learning phase which is going on. Everyone running their own cycle. While doing that, the learnings came from investment to how to run a business, how to run from, look at different aspects like governance, look at different aspects like, whether to run after accumulating more customers or focus on profitability. A lot of these jargons people were confused with, which they are learning from seeing various companies. That's what a phase what is running, which is getting into positive zone. Now, if you look at 2023, why to talk about what happened wrong? I think let's build up on what went right and how to take it further. And 23 is the year where the most number of IPOs have been listed in India. Worldwide, India is the only country having maximum number of IPOs. Even 22 did not seen that much. 21 seen a lesser number of IPOs. Of course, from a funding perspective, different jargons are going on, but at the same time, look at the funding trend. The late stage companies who are at a profitability or doing well are not having a challenge in raising a funding. So let's look at some of these aspects which are positive and which can drive it further.
Good to know, Mr. Panda. And as Dr. Malik beautifully put it out, that we must focus on what has been positive in the year 2023, and it's good for all. Mr. Khan, when I come to you, Mr. Panda, I slightly touched upon some of the jargon, some of the buzzwords going around. How would you tell us, in your opinion, the explanation, the definition of these buzzwords have changed in the last year? And when you look at the journey of any startup, irrespective of the sector, from seed to any scale, let's say IPO, how would that pace of that growth has changed?
Thanks for the question. I mean, just to, so I think 23 is a good year, certainly when you compare to 2020, 21 and 22, because, that was COVID and its aftermath. And you certainly had a lot of issues with exits. And as Dr. Panda pointed out, there were a lot of IPOs in 2023. I think what has changed and what my other panelists have pointed out is that there is a focus towards profitability. So I think when you design now if you're starting out in 2023 and you design your business model, I think you need to focus on making it very efficient in terms of trying to get to that profitability metric. I would say not very soon, because you still have to build the business, but at least in the medium term, right? So what was currently happening is that people are saying, hey, even if I'm 8 years old or 10 years old, I still won't be profitable. And I think the market didn't like that, right? We saw in 2021, a lot of these companies went in, they IPO'd, and then they sank to, by 60%. So that was certainly a signal, right, from the market that, listen, we don't like that and we are not willing to support this. So I think, founders are smart, right? They kind of work hard and they talk to people. So they've learned. And what founders are doing now is that they are sort of designing to get to profitability, let's say, in the 5th year, 6th year, and that's a better strategy, because then when you sort of get to the markets in, let's say, your 8th year, 9th year, at least you have a semblance of profitability. If not profitability, you at least you break even. So I think that is what has changed. In terms of the VC lens, I think VCs are also looking for that lens, because they were also bitten a lot, right? Because they went and companies IPO'd, and like I said, they sank, and then people who had invested couldn't get their money out, or they got very poor returns. So I think the VC lens has appropriately changed, and I think rightfully so. That you don't have a lot of wasteful expenditure, which is now taking place. So I think that is what has happened in shifting.
Fair point, Mr. Khan. Dr. Malik, most of your investments, you do it very passionately, and especially in their very, very early age. Mr. Khan is mentioning a point about compliance, and when some of the failures of startups kind of backlashes to investors. What is your take on this? How closely, how compassionately an investor and a founder needs to work?
It completely depends on the kind of model that you are running. So funds manage public capital. I can never be a disciplined investor. I have so much respect for venture capital firms and VCs, because managing capital in the startup space is, and people think a job of a VC is very simple. It's the hardest job on the planet. It's extremely, extremely hard. So the good part with people like me is we invest very small amount of capital and it's completely ours. The day, and I call it burnt capital. जिस दिन हम पैसा डाल देते हैं, we write it off. We don't care whether it comes back, it does not come back, and truly we can genuinely support founders. But for a VC, when you are managing public capital, you can't do that. So I think it depends on the kind of model. For me personally, at least how we invest, it's extremely founder-friendly capital. We just invest a small amount of capital just as a cheerleader. We don't care about governance. We don't care about the returns. Absolutely, like example, Anirudh is here. Anirudh, we were in the first round of Anirudh's round. He runs a content AI company called Pepper. Now, Pepper just raised, I think, at a 510 crore valuation, and we had invested, I think, 7-8 crore valuation. So we do get lucky at times, but at the same time, even if we don't get, it's absolutely fine. So these are different models, but with a VC you cannot play like that. So I think it depends on the kind of place that you are in the entire ecosystem. At the same time, I truly believe today our VCs are also getting a massive catapult in the kind of way that they work. Earlier VCs were completely gung-ho about just grow at all costs. Today, when you talk to VCs, they are very mindful of the fact that you will not hire senior leaders without ensuring that there is a need of the role. I think people being frugal, and in my case, हमारे पास तो ऐसा कोई VC नहीं है हिंदुस्तान का जहाँ पे हम गए नहीं पैसा रेज करने के लिए, and सारे VCs ने मना कर दिया था. And we realized one thing, that the reason was, one of the major reasons was that our focus was that we are not a tech company. हम तो co-working चला रहे हैं. Now in co-working also, if you end up making a loss, that means there's something absolutely wrong with your model. So, and now we realize, and finally we were fortunate that we sold the business at the right time. But the idea is, old things always work. I'm a big fan of Charlie Munger and Warren Buffett. It's very simple. Ensure that you charge more than, and truly speaking, there are only two models. In India, unfortunately, platform models are being valued in a different way. Example, Amazon is a platform. Now for a platform, you can charge and you can afford to not make a profit for 10 to 15 years. Whereas for a D2C brand, you are leveraging the platform. You cannot expect to get a valuation like a platform. And that is where the disconnect is. The PE ratios, we don't have ease right now in India, but the ratios are completely skewed. And this is a good thing that these things are changing now, and hopefully we will be in a better position in the coming years.
Very good point, Dr. Malik. Before we actually get deeper into what is angel investing is, what is VC. How many of you have absolute clarity on what is angel investing, what is VC, what is venture debt? Clearly not 100% of you. So anybody would want to take it up? Just clarify quickly, what is VC, what is angel investing, what is venture debt?
Before that, I just wanted to add a different perspective on what we just spoke on. I completely agree to what the point that you're making on. So we manage people's money, right? We are responsible for everybody who's investing, and I've actually seen a huge shift, like I was mentioning, in the last, say, 15 months or so. Just on the same points that we just discussed: compliance, due diligence. How seriously are the founders understanding the responsibility once you've raised money externally? So, like I was mentioning outside, my view is that if you have given off even 1% equity, and I want to re-emphasize that, even if you've given 1% equity to an external investor, you are responsible. It is no longer your company only, which means that from being a founder, now you are a shareholder, and you are, you're responsible to the board and to the investor. And if I look at our portfolio, so we have a portfolio of about, say, 250 companies and 100 exits and stuff. The key difference between the companies that did well and the ones that didn't do was how seriously the founder understood their responsibility in building the company out for growth. So there is exuberance when you start out. There is a very, very patient capital. There is cheerleading capital, which is absolutely critical, for you to just go out there and say, do what you can, right? The minute you come to institutional investors, people like us, people like, Rehan, who are saying, now can you talk to us about growth? That is the one thing you need to bring in. You need to bring in responsibility. You need to bring in intent. You need to bring in due diligence. And, by nature, what we do is risk capital. There should be no, beating around the bush on what we do. It is risk capital, right? So there could be 100 reasons why a startup could fail. And an investor is absolutely okay with 99 of them. What they are not okay with is founder neglect and founder malintent. And unfortunately, I think both have started coming up, the frequency of that has started coming up through the entire range of, startups, pre-IPO right up to where we invest. And as an ecosystem, we need to actually sit back and say, what is required for both the founders and the investors to take that up very seriously.
Very, very important point, Nandini. I would also request all of you to kind of put light on how investors are investing, and in some way they're also entrepreneurs, and they also have, not only monetarily, they're completely invested in your dreams, your passion, your journey. What's in it for investors in your respective spheres? Be it angel investing, be it venture debt, be it venture capital. We'll come back to this later. But before this, Mr. Khan, what is your personal view on some potential exit strategies? What, in your opinion, would you suggest a good growth stage level founder to do a exit, maybe OFS, maybe IPO? What would you suggest? How do you look at some of the potential exit strategies? In 2023, we have seen Mithun Sacheti exiting CaratLane. I have done a huge in-depth story on that. But what would be your take on this?
So, see, there are two kinds of exits. There are exits for investors, and there is the founder exit. Founder exit is actually a very rare event, like in the case of Mithun's, where he went and he sold his company, and or in the case of Dr. Malik here, where they went and they sold their company, and now they're sort of not on the treadmill anymore. Yeah, but if you go and you IPO your company, you're still running it, right? IPO is actually just another round of capital in many ways. When it comes to investor exits, the story is different. Investors truly exit. And typically they would exit in stages, right? So while your company is not public, they would take out some money by selling it to other investors in the private markets. And of course, once the company is public, then they will sell in the public markets. So investors, and because investors are investing for the purpose of returns, they need to exit, right? They need to put in the money and then get a return out. Of course, you've got you've got Warren Buffett style investors. We don't have those in India. But you've got Warren Buffett style investors which want to stay invested forever because they have a dividend based model, right? So they invest in the company and then the company keeps giving them dividend. That's why they only invest in certain companies, Coca-Cola, Apple, which are sort of very high dividend paying companies because their model is different. So that's how it basically works in a nutshell.
Good to know. Good to know. Now I'm coming to Mr. Panda. We missed a very basic point, but that's necessary for everybody. Can Mr. Panda do this for us? What is VC? What is angel investing? Now venture debt as well, the newest one.
No, thanks, Resma. I think before I jump into that question, I'll add on to a point what Mr. Malik mentioned. I think from a founder lens, because the moment they get into institutional funding, they do enter into a lot of restrictions in their documents. So they effectively don't get an exit so soon. They do have a lock-in to what extent they can kind of free up their shares. All those restrictions are there in the document. So their exit is one way is slightly delayed or it is a restricted exit. But at the same time, the other way to look into it is VCs wanted the founders to continue the business, to drive it and scale it up, which is more important from a business point of view, from a scalability or investor return point of view. That's the point just I wanted to add on to it. Now coming back to briefing about various stages of funding. We have Nandini here who is expert, having 15 years of experience. Angel fund is typically when you look at your close knit of investor who could be friends, families, or known circle of people who can come and invest, believe in you and your business model at a very early stage. We have Mr. Chaturvedi talked about his life story 2 sessions before. The example that he gave, someone believing in him for a 1 crore rupees, he trusted at an early stage. Now, equally it comes to you as well to keep the trust maintained and to deliver a return to give more, which is a very important point. In fact, that's the reason I came in 2 sessions earlier to listen to some of our earlier panelists and take some, carry some takeaway for me as well. Coming to the VCs, when the business grows a bit, you actually proven your market, achieved certain milestones, you reach out to institutional investors or investors who can come in with bulk of money, are primarily categorized as a VC capital. Venture debt is the stage which comes in when any institutional investor already invested in your company or you have reached kind of closer to Series A or above. Venture debt typically believes in kind of growth stage companies because when you take a debt, it's a mix of, the return is a mix of a fixed coupon plus a equity stake. Now coupon, the companies needs to have the ability to service the coupon, which is very important here. So those who think like, okay, I don't have an equity, but I can take a debt, might be they'll have to estimate what stage they are into. Now, in the venture debt space, the banks do not come in early who can be a debt provider to the companies, but they come in at a stage when company reaches towards Series B or above or have a profitability. So banks' criteria is completely different when it comes to lending. That's where venture debt plays an important role at an early stage. While it's providing a capital, it saves the founders from an early dilution perspective. That's the differentiator between the angel, VC and venture debt. We as Valuable have partnered with a large private sector bank where every investment that we do companies do get a bank early on into their financial as a balance sheet lending. Thereby, we blend the lending side of it to reduce the cost to the founder, at the same time save the dilution. That's what the differentiator we bring to the market right now.
Great to know, Mr. Panda. Now, reading a lot of news articles, listen to a lot of industry leaders such as you, we kind of understand that the process of correction, this is cyclic. This has happened in most of the developed nations already, and this is for the good. But in your opinion, how much more time will it take for India to settle down, navigate well through this time? Point number one. Point number two, can you somehow put it in pointers? 1, 2, 3, 4, 5, maybe 1 would also work. What can be some of the do's and don'ts when startup founders are stepping into 2024? Anybody can take it up.
I'd like to start with one. Don't start out by thinking you're going to build a unicorn. So, I always like to ask this question when I speak to founders on saying, why are you doing this? Right? And the answer has to be because I can't not do this. I'm that passionate about what I'm wanting to build or what I understand. I've seen that gap and I really, really want to do this. And there was this one founder that we met and I said, okay, why are you doing this? And that one question gives you a lot of insight into why people are doing it. And then that founder said, he says, because I was born to build a unicorn. And what I'm trying to highlight is you're not doing this to chase valuation. You're not doing this to become a billionaire. That is a byproduct of what happens, right? And what you need to decode as you look at this is actually when a company grows, the founder actually makes money the last. You're in the sequence of who gets the money when something grows, the founder gets the money last. And if you're doing this because of the money or because of the status, I think you've just not got the game right.
This is what 2023 has kind of taught us to go the right way, and we have many examples of valuation markdowns. Dr. Malik, please.
First of all, bang on. I think unicorn as a word should be abolished, and the challenge is our country's government is amazing, but they should not emphasize on the word unicorn. Unicorn is a mythical structure, and how are you valued in a private market does not make you valuable or not. So in my opinion, that is one. The second piece is, at least for founders, one of the key things that I always focus upon is there a theory of natural attraction in a business? Without putting money on Facebook, Google, is your customer coming to you back again with more customers and becoming a brand ambassador for your product? If that happens, then you have achieved something which most of the founders have not achieved. आज 40% Google और Facebook को हम लोग जो भी VC हम raise करते हैं, 40% goes to Google and Facebook. Now, that is something. If your cost of acquisition is high and if your cost of acquisition of customer is perpetually not going down, that means there's some challenge within your model. I always tell founders, and when we talk about stages, while there are stages pre-seed, seed, pre-angel, angel, and XYZ, for me there are only 2 stages, MVP and PMF. Where do you enter? For me, entering at the ability is if you are able to build a minimum viable product and the journey from an MVP to a PMF, and then from a PMF going forward, these are the 2 things. If you raise capital, which is growth in nature, and you end up raising it from a VC who expects you to grow at say 15 to 20% quarter on quarter, you will never be able to raise the next round. So my submission to every founder is take it slow, be absolutely patient. By the end of the day, you are not here to impress any VC. Your goal is not to raise capital. Capital is the last thing that you should raise. I always tell them, raise the bar for the customers, raise the bar for the consumers, make magic happen on ground, make the product so drool worthy that people come again and again and again to use your product. And aap customer le aao, VC, and the interesting part is there are more number of VCs in the world than great founders, and VCs get attracted like a magnet to great founders. When I wanted to raise capital, not even a single VC would want to invest in my business. We ended up raising a 35 crore venture debt. And that was the best thing, because at the time of exit, I had majority of my company with me. But today, a lot of VCs keep asking me, यार अगला venture कौन सा कर रहे हो? आप है ना seed raise करो. मैंने कहा कितने का? कहते हैं 5 से 10 मिलियन तो आजकल seed serial entrepreneurs को मिल जाता है. मैंने कहा $5 million is 42 crore rupees, 45 crore rupees. मैंने कहा मतलब it's like उतने पैसे में, मतलब उतना, you don't need that. The idea is capital is the last thing that you should raise. Always raise the bar, make magic happen for the consumers, and be a purpose. And this is a very interesting point. A lot of founders tell me, yaar, tell me industries where I should start a business. When I go, who am I to tell you the industries in which you should start a business? Start a business in an industry in which the product you feel is inadequate in the market today. Start a business in something that you like. I'll tell you why we started co-working. I used to hate going to offices built by these conventional real estate people. And I realized there's such a large market to create suave offices in Connaught Place and with a community which is very vibrant. I used to go, I was an entrepreneur back in 2015. I used to take an extension cord with me, put it in a Starbucks, and पैसे तो होते नहीं थे, तो एक कॉफी के लिए 4 घंटे स्टारबक्स पे मैं बैठता था. उनका वाईफाई पूरा कंज्यूम मैं कर लेता था. उनका वहां से बरिस्टा आता था, and he used to tell me that, dude, you really need to get out of this place. And I realized that can we create a Starbucks styled co-working space at as low as 5,999 per month? So I think once you have a problem, solve for the problem, not for raising VC capital.
Thank you so much. Thank you so much, Dr. Malik. Mr. Khan, we will quickly conclude this. In 2024, how would your investment strategy would somehow reshape? Would you reshape, or how would it change in 2024?
Sure. So yeah, it's always hard to make a prediction, but here I'll take a stab at it. So I think first of all in 24 we're going to see a lot of good IPOs from the tech space, right? So what happened in 21 is that the companies, you know, some of them IPO'd and then, like I said, they sank. So that caused everybody to retool their numbers and their model. So I think you'll see a lot of those, right? Like you just saw Mamaearth came out with a grand IPO and has done very well. So similarly, you will see Swiggy and a lot of these other names which are out there. 2 of our companies are also IPOing next year. So there's going to be a stampede of these IPOs. It looks like, you know, the government is going to be stable. So I think we're going to see a lot of them come out and IPO next year. And what that is going to do is that is going to drive a lot of positive sentiment back into the startup ecosystem, because, you know, VCs would have made money, angel investors would have made money, and they're going to be flushed with this cash, and they're going to be putting a lot of this money back into the ecosystem. So I think 24, 25, you will see availability of capital go up significantly in the startup ecosystem. And then now to talk about sectors. So I think, you know, of course you have the usual sectors, and the usual sectors are going to see innovation, right? E-commerce, fintech, edutech, health tech. There's a lot to be done in there. You've just about scratched the surface in all these sectors. I mean, you take e-commerce as an example, D2C brands, which are a subset of e-commerce. There's a lot of opportunity to build these brands because marketplaces, right, like Amazon, Flipkart, and so many other marketplaces are providing access to a lot of customers where you can launch your brand, you can get to 100 customers 100 orders a day very quickly, then to 1,000 orders a day, and then you can sort of take it from there, right? But in addition to the usual suspect sectors, you're going to see a lot of action, I think, in hardware, which is coming up. You already have a few hardware startups, right? Ola Electric is a hardware startup, Lenskart, you have Atomberg, you know, quite a few others. So you're going to see a lot more coming up in hardware. I think you're going to see a lot happening in manufacturing because of the whole China Plus One push which is taking place in there. And, you know, you'll see many other sectors sort of bubble up. So I think it's very interesting times in 2024.
Good to know, Mr. Khan. Quickly, Mr. Panda, a piece of advice to young founders. What should they do in 2024?
I should not tell them what should they do, but one fact remains is, you know, the bootstrapped companies always strive for cash, right? But when you compare with a funded company, they strive for independent, innovative ideas. They always go with the VCs or the investor strategy to modify their product. The point they lose in between is what they're known for or what they pivoted into to do a business. By the time they scale up, they get into something else, not the business they have been doing. The more important point is stick to the core, remain true to your passion, deliver what you promise for to the investors from an early stage perspective, and carry that on, pivot wherever necessary, bring in the independent innovation on a continuous basis, remain more sustainable. That's more important from a business perspective.
Thank you, Mr. Panda. And on this note, we would like to conclude this panel. I am highly grateful for all of your... Ji. Ji, please.
When you meet founders, Resham asked you the question, what can you guide them? But I meet founders, I'm not an investor, but I learn a lot from them. I want to know from Mr. Khan and Mr. Panda and Nandini, what have you learned? Give us an anecdote where you met a founder and you learned something. Because, I'm sure all of us can learn from people like Ritesh, right?
Yeah. So I'll go first, take the privilege. I think I always, get into the basics. So when someone starts a business, that's a typical problem. We started with the question, I'll take one aspect of governance, right? I'll give you a simple example. No one is an expert in multiple aspects. Even today, I do learn from many of the juniors who are at college or school level when I meet them. I heard from someone an example, a kid talking to Alexa, and Alexa did not adhere to it. And he said, shut up. The kid responded to the parent saying that, are you teaching a device a rude behavior? Now that could be something a learning. Machine is recording the behaviors that human is giving to them. What is AI today? And these are the small learnings we take every day in, day out from home or college or workplace, wherever we are. Let's take another example at a startup space. We do use consultants day in, day out. For a company sitting at an office, they don't know on a daily basis, there are 10 circulars which has been issued by multiple departments at a government level. Now for a people doing a compliance or governance, he will look at a consultant who will do for a 500 or 1000 rupees, which is the consequence of 1 lakh as a penalty. Now how do you expect from a people who is not fully updated, and you expect them to deliver you at a peanut and then blame him for not doing the compliance? Now this is something, a small example, but something to be carry on. How do we do every task which is in hand? Are we using the right set of people to deliver? Are we right in our approach? For the founders at an early age, what kind of culture they carry to the other people makes a big difference on a continuous basis, because these organizations to grow.
Got it, Mr. Panda. Mr. Khan, a little more interesting anecdote.
So I've been very fortunate to be associated with some spectacular founders. Bhavish at Ola, Jaspreet at Dhruva, and so many others, right? Chakradhar at Country Delight. And I think each of them have, a lot of things that I've learned from them. But in the interest of time, I'll just talk about one founder. I'll talk about Bhavish at Ola. I visited, I met Bhavish when he was very young. He was 25 or 26 years old. And that's when we invested in Ola, right? 11 years later, he's still only 37, right? And I visited him the other day and in Bangalore. I hadn't met him since COVID, and then I met him, and, we went in the helicopter to his factory. He's built this factory outside of Bangalore, so the only way to go there is by helicopter. And what Bhavish told me is something very interesting. He's still very humble, as a person, despite a very, very large organization employing over, I would say, I think 11,000 people. He's still very humble. And, he said something which sort of stayed with me. He said, our grandparents' generation were freedom fighters. Our parents' generation was about roti, kapra and makan. And our generation really needs to transform this country into a developed country. And that is my endeavor, right? And I'm going to do it through, I'm just 37, and I'm going to try and do what I can to transform this nation. He said, whatever it takes, right? He said, and I think at that time, Narayan Murthy's 70-hour week thing had come out. He said, 70 hours, you should be working 100 hours. He said, I'm prepared to work more hours than there are in a day to make this thing happen. And that really stayed with me, after I sort of, I came back home and I sat and thought about it. And I said, yeah, when you really think about India, and there's still so much poverty in the nation, right? And a certain set of people, privileged like us, we of course enjoying great lifestyle, but there are a whole lot of people without access to Medicare and basic income, that it really is a time to work to transform this nation.
So transformation at scale.
Transformation at massive scale. Yeah.
Nandini?
Am I audible?
Yeah.
So I think if there's one thing that actually differentiates a good founder from somebody who's just trying, is grit.
Of course.
Just the ability to stand through ups and downs, and the ability to hear no over and over again, but still believe that what I'm trying to build is of value and it can scale. So whenever I meet any founder, that's the one quality that I'm always looking for. And in India, what we've seen is that, if you have grit and you have belief in what you're doing, sooner or later something will come out.
Okay.
I think that's the...
Don't tell that to Rahul Yadav, the rest is okay.